And what's going on? All right, so this is going to be the only Trade 1348 video you're ever going to need. I'm going to bring you guys to the charts. We're going to fall back on old school 1348, and then we're going to start adding on layers. Now, the purpose of this video is to become the one-stop resource for everyone in the community to answer all your questions. Now, Market Talk, I'm going to be honest, I've been contemplating removing it. It almost feels like when class is in session, we have the kids talking, distracting those who are trying to learn, and adding additional layers of complexity when the system itself is absolutely simple. So, let's get right into it. We have, oh no, where are the candles? Where are the candles? Gabe. Okay, I purposely removed the candles. Now we have some labels here, and this is from the genie indicating reversals and die gap reversals, etc., etc. But what I want to talk about are the EMAs. Okay, the EMAs. The strategy is very, very simple. When price action breaks below this yellow line, you are biased to puts, right? This yellow line is your 200. Cool. You see the blue line is your 13. Cool. The red line is your 48. Cool. Now, the reason why I'm showing you without candles is to show a couple of things here. First and foremost, when price action is above this 200 EMA, which we could assume it is because the 13 and the 48 are above the 200 EMA. When price action is above, we're biased to calls, so therefore this call signal would be valid. Now, we do have a put signal, and when price action breaks below the 200 EMA, we're biased to puts. However, before we can be biased to puts, it has to become a put somehow, correct? Especially when we're looking for reversals. Okay, so this here is where I'm going to draw. If you are anticipating a put when you are above the 200 EMA, you would have to accept that this may possibly be a scalp and that price action will bounce back off the 200 EMA. That is the general expectation. You play the put. However, when you are above the 200 EMA, you're playing the put only to the 200. And then you look for a re-entry below the 200 to continue the rest of this move. This becomes a two-part play. Okay? We could say the same here. We have a call here, but since we're below the 200 EMA, we are biased to puts. Well, we go ahead and we play this call with the expectation only of the 200 EMA. Now, if you look closely here, you can see why we have this rule in place. We have the rule in place because, as you can see here, price action can in fact reject from it. In fact, you can see the 13 struggling to break the 200 EMA before it finally clears and then gives us the rule-based trade. Once broken, you are now biased to calls because the EMAs and price action are now above the 200 EMA. In this example, you could see how this is valid. It is valid here in this example. In this example, this put, this is exactly why we train you and condition you to play just to the 200 EMA. This put signaled. This is a scalper's signal by virtue of both the EMAs and the price action being above the 200 EMA here. You would then, with the expectation that this put reverses at the 200, you then go ahead and you take the proper bias call which is, again, price action, EMAs above the 200 EMA, you are biased to calls. Below the 200 EMA, you are biased to puts. When there's a conflicting signal, you are playing for a scalp. I hope this makes sense. Okay, moving along. When you look at the charts here, you could see that these are hardly perfect lines here, right? This is hardly a perfect 13 EMA, and this is hardly a perfect 48 EMA. When we go to the 3-minute, you could see how this becomes smoother. Furthermore, when we go to the 5-minute, you could see how it becomes yet again even smoother. For some of you who are having anxiety or feel like you're missing the play, you should allow yourself to play in a larger time frame, whether it be the smoother 3 or the even smoother 5. Okay, now this is traditional 1348. When the 13 crosses below the 48, you are in a put. When the 13 crosses above the 48, you are in a call. When you are above the 200, you're biased to the call as there will be more strength. When you break below the 200, you're biased to the put as there will be more strength. And you could see how this example paints itself over and over and over again. We see an example here where there is a call that comes up to the 200, breaks it, fakes everyone out, and then comes right back down. So you take the call as a scalp, you then take the call to the upside, you then understand that this put is going to bring you back down. In this example, this is also a 2-part play where you open below the 200, you take the call with the expectation that you're coming to the 200, and then look for another play or an additional setup that will help you play the rest of this here. Okay. This is what I want you to get into practice in doing, whether it's on the 3 and the 5. Now, some of you like to play on the 1, but the 1 will be far more noisier. And if your stomach can't handle the chop, 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 you could see chop, chop, chop. If you can't handle this volatility, slow it down and play on a time frame that your stomach can handle. Okay, we got that out of the way. Now what I want to do is introduce to you the traffic lights, because the traffic lights are designed to guide you into the 1348 play. Okay, so we go back to the chart here. We're going to go ahead and enable the 13, the traffic light, and we're going to go ahead and enable, let's see here, the 24. Now, why do I have this enabled? Well, let's get right to it. Now, in order to teach this out, again, I'm going to teach it on the smoothest time frame. And here we go. So what you're seeing here is a 13 put playing the first leg for you into the 200 EMA before the put actually happens. So this is a traffic light signaling a put, which guides you to the 200, of which the 1348 takes over. In this example, we have a traffic light signaling a call, which guides you in up to the 200 before the 1348 takes over. I want you to think of it as like a, 2,000 meter relay. I don't know if that's even a distance, but you're passing the baton, okay? And this is what's happening between the indicators. We don't live solely in the 13. We utilize the 13 as an opportunity to enter, and then we're looking for a re-entry below the 200 with a put signal. Again, we're looking at the traffic light signal here as an entry, and then we relay it into a call above the 200 EMA. And we can see this time and time and time again. Of course, there's some days where we just get chop city. And in this example, you got traffic light, traffic light, traffic light. Traffic light leads into a call, makes you some money. This was a very, very flat and wonky day in the market. And not every day is a trading day. We'll get to that in a second. In this example, we have a traffic light that leads you into a call, which brings you right up to the 200 EMA. Notice something. The 1348 continues. As you can see here, the cross only happened once. But the traffic light's responsibility is to get you into a leg. Now, you get a put signal here. And this put signal on the traffic light here has identified that the traffic light leg of the play is now over. Why is that? Because you have a candle close beneath the 24, or you have a candle breach and close through the 24 EMA. We then get another candle, a traffic light to the upside. Again, this is highlighting something here. When price action is below the 200 EMA, you are biased to puts, correct? We set this. And the reason why I want you to keep this in your mind is because every traffic light which is attempting to initiate a leg fails as it's hitting its head against the 200. We get a traffic light to the downside here, and we get a bounce, and then we get another traffic light here, and then a continuance. We have to treat the 200 EMA with a great deal of respect. Now, we're going to get price shown in a second, but what would be the ideal exit here? Well, your ideal exit would have been here as we were hitting the 200, right? That would be your ideal exit. Alternatively, what we can do, and let me get rid of this drawing here. What we can do is then wait for another setup to bring price action above the 200. And that will be this setup here. Okay. Now let's say, or actually, let me rewind here. We found you an exit, an ideal exit here at the 200. But if you did not listen, you have this zone here, the 24 EMA, to help you get out of this trade, which would still make sure that you are profitable. And this is why we have the 24. The 24 acts as the last resort exit. Okay? That's what it acts as. Now, here we have a traffic light that breaks above the 24. Do we enter here? Well, let's find out. We are going to enable the candles. And we're going to delete everything here. Now, none of us know if we are in fact going to get a break through the 200. However, what we do know is if we take this trade at any one place here, we will establish either the 13 or the 24, again, the 13, the blue line, the 24 being this gray line, as our risk. You got a traffic light here. You establish now the 13 or the 24 as your risk as you are entering this play. As you can see here, the 24 has guided you to an exit. We're going to show you right here. This candle is your first candle. This candle here is your first candle that breaks past the 24, which would ideally be your exit point, of then which you then get a traffic signal to the downside. You see, which then brings you into a put signal. Now, why do I share this with you? Well, I share it with you because there happens to be a lot of confusion as to why you enter and why you exit. Now, I'm showing all of you this without levels, and even without levels, simply by using the 24 on a smoother time frame, being the 3 or the 5, you would be able to guesstimate with levels and with risk where momentum is going. If we were playing this to the upside, we established the 200 to be a possible level of which we would exit. We would also establish the 24 as our last resort to exit. We get a traffic light to the downside here. Where do we establish our risk? The 24. As soon as we respect our risk at the 24, assuming that we want the candles to come down this way, the minute we see it break against that 24, the play is over. It becomes non-negotiable on whether, will the play come back to me? Because it does, right? But then it doesn't, and we'll get to that in a second. At this point, the reason why we give you this system is so that you can do it over and over and over and not allow your emotions to be misguided. This is why the 24 is there. When we look at the very next candle breaking through the 24, we know our thesis from this put is now over. Moving along, once we see a candle break once again through the 24, this thesis is again over. With this candle, we built the thesis that she will be moving up. And she didn't, not on this candle. And you would be wise to have closed your position at the 24. Why would you have been wise to close your position at the 24? Well, because although you finally had a traffic light that brought you above the 200, you were still speculating on whether you were going to break it or not. So, at the break of 24, this candle becomes invalidated. We then set ourselves up for these pairs here. As you can see, we break the 24, we quickly get another traffic light to the downside. Now, we're not entering on this candle, right? Because the alerts we're receiving are after candle close. Immediately, once again, a candle breaks above here, and it breaks above the 24, and this is the valid trend. And basically, the point I'm trying to make here is that as long as you establish a risk along the EMAs of your entry, you will never go wrong. However, if you remain undecided with a traffic light, always use the 24 as your risk. I hope I make that clear. Okay. So now we're going to add additional layers to this. Now, if you're wondering if this works on all time frames, it does. Although we move to the 3, we see there's a little bit of noise. We get a traffic light below. We get this traffic light up. It breaks through the 24. You get a little bit of movement. Then we get a traffic light down. But before we get this traffic light, we already see a candle breaking below the 24 before we get a traffic light. Using the 24 will keep you out of harm's way. More importantly, now that you see the candles on the 3-minute, you could see that this was just nasty chop. So the 24 is not only going to help you secure the bag and or cut your losses immediately, it's also going to help you identify when you're in chop, especially if you're getting traffic light, traffic light, traffic light, traffic light. Okay. And that's where we have thigh gap, and thigh gap is a master's only indicator. And I would advise many of you to upgrade to master. Please do it. You will definitely benefit from it, especially with my morning classes. Okay. But going back to the chart here, the 24 is going to be our line of demarcation, and it's what's going to invalidate or validate your traffic light signals. And that's okay. I'm going to show you guys something. And this is why we say play with a smaller position. Because if we measure this out, even if you were wrong through this entire sequence, okay, you were wrong put side, and you entered on this candle, but then finally gave up where it worked against you on this candle. That's only a 40-cent move, 44-cent move. Whereas because you were nimble and quickly exiting your positions, you allowed yourself to take advantage of a $1.38 move. In this example, you're also allowed to take advantage of this move here to the 200, which was about an 80-cent move, which then puts your portfolio in a position to play smaller with your profits and assume less risk. And we're going to get into that in another video. And I believe STV has covered risk management a lot. He's covered it a lot, okay? So maybe I don't need to cover that. However, we do have another traffic light. And again, this is on the 5-minute. And using the 24 as your risk, should you have gotten in on this traffic light, that's a $2.77 move, right? Let's actually wait till we break the 24. That is a $1.17 move, waiting for that candle to break the 24. But of course, you're wise enough to know that something's amiss when you see consolidation and you get your first candle break of the 13. You probably would not have allowed it to break that 24. But even if you did, and you exited here, you still stand to profit $1.54 in a move. If you waited until the next traffic light, you only made 74 cents on the move. And this is the importance of using the 13 and the 24 as a possible exit. Okay. Me personally, I prefer the 24. This is what's going to keep me from getting faked out, and we'll surely find an example that I can cover that shows how it rejects from the 24. So this is basically trading the traffic lights, the 1348, and the 24. Just this alone makes the system awfully simple, does it not? It sure does. Now, what do we have here? We have the MACD and we have the RSI and we have the ADX. Now, the ADX is basically a legacy indicator to me. We have replaced that with a thigh gap, and I will show you guys an advanced chart and how you could benefit from that and actually make even more confident decisions. But what we do here is we use the RSI. Let's say we entered on this traffic light, it became a call, we run it up. We use the RSI as our exit, as our first clue to exit. If we don't get the memo, then we use the 24 as a level to exit. Okay. What this is also going to show us is basically a trend, whether the trend is to the upside. So if RSI is above its moving average, that's why you will see it's highlighted in green. That means that it is bullish. When you see it below the moving average here, this yellow line, you are in fact bearish. But bearish until when? Now, let's say you decided to front run a traffic light and say, well, RSI broke, the candle broke, we have momentum to the downside. Well, you have a visual cue here of the 48. Again, before we even put any of our support and resistance on the chart, we can literally use just these EMAs to paint our risk, right, and our reward. Should we take this move down to the 48, we could immediately see that there's sensitivity with the RSI. And that would be a signal well before the 24 that it's time to get out of that play. This is how we would use the indicators. We use the indicators together to help plot out our thesis. Okay. Now, in this example, we see that the MACD is bullish. And you know what? The MACD did not serve you wrong whatsoever. It is where you reach these peaks and valleys where you have to rely on your EMAs and the RSI. But if you believed in the 1348 crossover, it would certainly have guided you through the entirety of the play. Again, we use these indicators to help us plot our thesis and help us understand what's happening within these candles to help us better enter and exit. As you can see here, moving along, the MACD does build up some momentum here. And so we have this traffic light, but we also have the RSI break above its moving average. Again, it's an additional confirmation to the overall thesis where we have the traffic light here. We have the 24 as our risk. RSI broke above its moving average. MACD showing bullishness. And the ADX is showing strength along the move. Not very complicated. I hope not. Now we're going to add additional layers. And as you can see, the additional layers are simply complementing every layer before it. Okay? So what we're going to do is we're going to go back to the chart and we're going to go to settings and we're going to enable resistance and support. And we're going to enable the labels, which give you the value. And we're going to enable the genie once and for all. Now this chart is looking a lot like what you're used to. Now, let's go ahead and look at what we're dealing with here. If you took this trade, you would immediately be able to identify that the 200 is a level and that this may be more than you deserve here at 412.87. Now, why 412.87? Why did that level print? Well, if we see that you have price action that's struggling, we simply go ahead and we draw a line. And we can see immediately that line brings us to at or about this level here, a historical level. Now, a lot of you ask, like, hey, on the 5 minute, how far out or how far back do you go? And my answer is really, really simple. I go back almost as many as 5 to 7 trading days to find my level. And this is going to give me context in the trade. Now, for those who are wondering if you can't move fast enough to plot this level, remember, you are on the 5 minute. So you have your time here to do your research and plot your level. At first glance, immediately, you would say, oh, this is a level. Okay, it's giving me more than I deserve. Then, by the third candle, you get an RSI break, which confirms that this level is in fact valid. Moving along, we could see when it breaks to 200 once again, you could see how it is responding to this level here. So you know there are two challenges in this trade to the upside, and you are not going to be left holding this bag here. You have the traffic light to the 200 EMA. You finally break it, and now you can breathe that sigh of relief. But you know there's another challenge coming. It's here. Okay, well, how do I know I'm going to break that level? Truth is, you don't. What you can end up doing is either securing the bag here or scaling out. Now, there are other things you can do that would help you to better understand what's happening within these candles. And this is the only time where I would say you can go to another time frame to take a peek at what's happening here. And so what I'm going to do is I'm going to draw a candle or a stem right here. And I'm going to use that as my marker. And I'm going to go to the 1 minute, going to zoom out until I find my marker. I believe this is just the wrong day entirely. Let's see if I can find my marker. Where are you, marker? And I can't seem to find it. All right. This is where movie magic comes to play. Ah, look at that. I'm 3 days back. El Bago. I'm coming for you, brother. I'm coming to save you, El Bago. Let's go to the 1 minute and go 3 days back. And here we go. Now, with the 1 minute, what are we seeing here? Well, this candle here, we're seeing that RSI is remaining above 50, although it's breaking below its moving average. It came up to a level here. That was your first. Remember, we saw it go up to a level, then we saw it reject. This is your rejection point. What you can do now is pay attention to RSI and wait for RSI to break 50, which is these dotted lines here, or wait for it to break the 24. It does not do that. It does not break 50 to the downside, nor does it break the 24 on the EMA here, which helps you build confidence. And once you get through this level here, you're able to breathe easier. Remember, this is a level we have to break through. This is this blue pill line, right? This blue pill line, if you draw it on the 5, it's going to show up on the 1, it's going to show up on the 3. You can now breathe a sigh of relief that you finally broke this level, which then brings you back to the 5. So now on this 5 here, you're now playing to protect this level, or you're playing until the candle break up to 13. This, guys, is as simple as I can paint this. There's no need to jump from one time frame or another, or to validate your thesis on one time frame versus another. You're just simply taking a peek as to what's happening within the candle and see if on the 1 minute price action is respecting the rules. If price action breaks to 24 on the 1 minute, then you know that you might be in trouble on the 5. Okay. So that's how I would go ahead and manage on whether I know I'm going to break or build my thesis, rather, if I'm going to break that level or not. Okay. This is as simple as it gets. Okay. I want you to watch this video over and over and over again. And in fact, this is how long? This is about a 35-minute video. Got me squinting here like an old man. But there's more. Let me introduce to you what the SAR indicator is and what you're getting in master. Okay? So we're going to go ahead and leave this here. We're going to go back to the chart, and now it looks like we got way more information. Well, you do, but I want you to think of the chart as a cockpit, as if you are a pilot. Now, the pilot's going to use different instruments to gauge different things, whether it's altitude, whether it's the weather, headwinds, tailwinds, all that kind of stuff. We are using different indicators to help us give us an idea of what's happening. So let me introduce you to the thigh gap indicator. And again, for those who are in master, who are just tired of getting chopped up, right? Let's go ahead and look at the 1 minute here. You can see the 1 minute has a lot of areas of chop. You could slow it down on the 5. You could definitely slow it down on the 5. Okay. And because you have these indicators, you can play the 5 more confidently. So let's look at NVIDIA here. And this one's actually kind of fun. And why is that? Well, in Masterclass, we used the 3 minute before market opens to plot our highs and lows, right? So in this example, with NVIDIA, we plotted the high of 271.45. And then we plotted the low of after hour and pre-market. We plotted that to 268 even. We then came to the 1 minute and we found our 200 EMA and we plotted this as well. Now, why did I do that? Well, at market open, the types of traders that are playing are the 1 minute traders. That's why we say maybe you sit on your hands until 9:45, 10 o'clock, where the 5 minute and 15 minute traders enter the arena. Just think of this as like Royal Rumble, right? All the 1 minute guys are coming in first. And you know what happens to 1 minute guys? They finish first. Okay. What we see here. Now, why did I plot this? Well, usually what I like to see is if, as you guys can see, we have the 200 EMA here. We have the highest point of pre-market here, the lowest point of pre-market here. And what I'm going to see is if it's bottom heavy. As you can see, the difference, and we could draw this out here, the difference in this area right there is much larger than the difference in this area. So what that tells me is that after the 1 minute men run the market, we would like to see it come back to the 200 and then let it find itself, let it play the correction. Now, this isn't a textbook rule. This isn't a situation where, oh, there's more room on the bottom, so I'm going to just go puts. No. What it means is that it puts everything into perspective for you, that if you're going to take this play or chase into this play, that is it may in fact be short-lived. Okay. That's why we say let the market choose the direction and you play the correction. The correction was to move back down into this zone, which of course it broke beneath. And then finally, it recaptured itself in the uppermost channel before receding back into this zone. Boys and girls, you can't make this up. This is what I want you to do. I want you to go ahead on some of your favorite plays. I want you to go on a 3-minute, plot the high of pre-market, the low of pre-market, and this includes after hours, which is the night before. And then I want you to go to the 1 minute, and I want you to plot the 200 EMA right before market open. And then I want you to pay attention to price action. Price action tends to go the direction of least resistance, and that's why I was a little skeptical of NVIDIA. I was skeptical of the whole entire market just running. It was a bait and switch. It was meant to pin you. It was meant to slaughter retailers. More importantly, if you got 1 minute retailers playing, can you imagine what the fractional algos that are playing the ticks, imagine how they're playing, right? You're not going to beat them, so you might as well join them. You might as well just go along for the ride of the trend, okay? This is one of my favorite things to do to get a gauge on where the market might want to go. Again, it's not a hard and fast rule, but it keeps you on your toes every morning at market open. And it keeps you from doing willy-nilly shit. Okay, so now that we got that out of the way, we're going to go ahead and break down the indicators once again. For those who aren't master, you know what's up. For those who are contemplating master, I think it's time you upgrade. But let's get back to this. What we see here, we see a traffic light, we see a put. What else do we see? I'm going to go ahead and actually draw a line here. We're going to draw this line here. That way you can visualize this. We have this line now. Now you can visualize this here. At the point of this traffic light, we have 1 indicator, 2 indicators, 3 indicators, 4 indicators, all in agreement of this move. When you are looking to enter a position, you want to see, ideally, that all indicators are in agreement. Otherwise, you're looking at a scalp. Now, what do I mean here? Well, let's look at the bounce off this level, the 270.41. Actually, you know what? Let's go ahead and slow this down a little more. Let's go to the 5 minute, right? Let's go to the 5 minute here. And let's see if I could find my stick. There you go. There you go. Okay, let's slow it down even more. In this example here, we have to bring our indicator 1 bar across. So we're in the 5 minute here. The traffic light down. RSI broke beneath its moving average. MACD crossed over into red. The I gap begins to print weakness and then prints a nice yellow candle to the downside. And the SAR indicator was already printing momentum to the downside. And so all of this agrees. When it doesn't agree, it's when you get something like this, and I can highlight this right here. You're showing bullishness here, but you're showing bearishness here. You're showing that there is bullishness here, but it's weakening, but you're showing bearishness here. And all that adds up to is this. Because we do not have agreement through the indicators, it all simply adds up to sideways action. Okay. Now, this is just one example of many examples. We could go ahead and round the 5 minute, and we'll do this one more time. On the 5 minute, we have a traffic light here. Now, of course, we're not going to enter on this traffic light, right? But we're gonna draw this here. Now, we're gonna look for an entry pretty close here to the 24, right? But what we're able to guesstimate here is a potential cross of the MACD, which is going to happen within these two candles here. You have RSI already printing blue, which is, you have thigh gap already printing blue, which is bullish. You have your SAR already printing green. You have your RSI also green already and above its moving average. So this would validate this trade as a scalp until it's no longer valid. Now, what keeps you in this play? You could get out of your play once you see a thigh gap reversal, or you see, again, now the indicators are going wonky here, right? The thing is that you can stay in this play confidently. Now, we're going to go ahead and mark this. This is where RSI breaks its moving average. It gives us a little scare here, right here. And what we're looking for is a break of the 24, not with a wick, but with a whole candle body. We're looking for a close and break of the 24. And we did not get it. And so because we did not get it, we're then rewarded with a call. So now this becomes the first leg that relayed into a call, which then brings us to this level. Let's go ahead and measure this play. We could enter here and exit at a level for a $2.80 move. Again, the setups will not be perfect. However, when you can, for the most part, get the indicators in agreement, and you can identify your risk here at the 24, you're going to do well. And I really hope this makes sense. These levels are here, and they exist to keep you honest. Otherwise, if you don't realize there's a level here, right, you go ahead and let's go ahead and draw this blue pill line right there. You can see that this level already exists, right? But why would you even start looking for a level? You start looking for a level because you just broke the 200 EMA, and this play has given you more than you deserve. And of course, you can see here, RSI definitely got overbought. And then thigh gap signals a reversal. Then SAR candles signal red. There's a lot of things that go into this, right? But what I want you guys to do is play the 5 minute or play the 3 minute. I feel like the 3's not as bad as the 1. As you can see, it's really not all that more intimidating. It does get you in a little earlier, letting you make more profit, but the rules are exactly the same. Traffic light down. You don't quite get anything close to your 13 here, so you are going to go ahead and establish the 200 as your risk. You're coming down. You broke your 13. Okay. Did you break your 24? No. We get a continuation. You broke your 24? Yep. Exit. Traffic light. Here? Okay. Enter. Enter. Rock and roll until you break the 24, which is here. or until you see a level, which is here. I want you guys to keep playing with price action and the 24 EMA relative to the traffic light. And this is going to serve you well. Whether you have the older chart or whether you have thigh gap and SAR candles, which we feel, honestly, we feel is certainly worth the upgrade to get these indicators. But it does not mean you can't do it without it. Okay? What it means is you're far more dependent on the rules than you'd like to think. All right? Far more dependent on the rules than you'd like to think. Anyways, guys, this is Gabe. I hope you learned something. Peace.